Before we begin, a quick and important disclaimer. I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. Auto insurance is a complex product, and your individual needs will vary. Please consult with a qualified and licensed professional to discuss your specific situation before making any decisions. This presentation is intended to help you become a more informed consumer, not to replace the guidance of a professional. You are being overcharged for car insurance. That isn't a guess. For millions of Californians, it's a statistical certainty. The average driver in the Golden State is now paying over $2,200 a year just for the legal right to drive their car. But here's the secret the big insurance companies don't want you to know. A huge number of those drivers, and very likely you, are overpaying by $500, $700, maybe even over $1,000 every single year. Think about that. An extra $1,000 in your pocket. That's a vacation. That's a significant chunk of your rent. That's debt paid off. And it's being siphoned directly from your bank account for absolutely no reason. You get the exact same coverage, the same peace of mind, but for a fraction of the price. Over the next 10 parts of this guide, I am going to give you the exact playbook to stop the bleeding. This isn't about finding some sketchy, no-name insurer. This is about understanding the system, knowing the rules the insurance companies play by, and using those rules to your advantage. We are going to dismantle every fee, decode every discount, and expose every trick they use to keep you paying more than you should. By the end of this, you won't just hope for a better rate. You will know exactly how to go out and get it. So let's start with the big question. Why is car insurance in California so insanely expensive? Feels personal, right? You get that renewal notice in the mail, you see the price has jumped up 10%, 20%, and you haven't done anything wrong. No accidents. No tickets. Your car is a year older. It should be cheaper, but it's not. Feels like a scam. And in a way it is. But to beat the system, you first have to understand the battlefield. California is a perfect storm for high insurance rates. First, look around you. We have more people and more cars than any other state. We have nearly 40 million residents. That's more people than the entire country of Canada, all crammed into one state. And with those people come over 30 million registered vehicles. All those cars on the road, especially in hypercongested areas like Los Angeles, the Bay Area, and San Diego, create a simple, unavoidable statistical reality. More accidents happen here. More collisions, more fender benders, more claims. For an insurance company, every car on the I-5 or the 405 is a potential payout. So, they price that risk into every single policy, including yours, even if you have a perfect driving record. Second, everything here is just more expensive. It's the sunshine tax we all pay. When a car gets into an accident in Fresno, the cost to repair that vehicle is significantly higher than if the same accident happened in Omaha, Nebraska. Labor rates for mechanics are higher. The cost of parts is higher. And God forbid, if someone gets injured, the medical costs in California are through the roof. A simple hospital visit here can cost tens of thousands of dollars. Since a standard insurance policy covers both vehicle repairs and medical payments, the potential payout for any given accident is enormous. The insurance companies aren't just going to absorb that cost. They pass it directly on to you in the form of higher premiums. Third, we live in a uniquely litigious state. People in California are more likely to hire a lawyer and sue after an accident than in almost any other state. This creates massive uncertainty for insurance companies. A minor accident that might be a $5,000 claim elsewhere could easily spiral into a $50,000 lawsuit here. To protect themselves from these huge, unpredictable legal payouts, they build a massive risk buffer into their pricing. You are paying for your neighbor's potential lawsuit. And finally, we have risks nobody else does. Wildfires, floods, atmospheric rivers. Thousands of cars are destroyed every year in California due to natural disasters. That's a risk that doesn't really exist in the same way in other parts of the country, and it's another layer of cost baked into your premium. So yes, the deck is stacked against us. The baseline cost here is high for legitimate reasons. But that is not the main reason you are personally overpaying. The baseline cost might explain why you're not paying $800 a year. It does not explain why you're paying $2,000 when you could be paying $1,500. The real reason you're overpaying comes down to a dirty little industry secret known as price optimization, or what consumer advocates call the loyalty penalty. It is one of the most anti-consumer practices in modern business, and it is the absolute foundation of the insurance industry's profit model. Here's how it works. Insurance companies have incredibly sophisticated computer algorithms that analyze your behavior. They know how long you've been a customer. They know if you pay your bill on time. And most importantly, they try to predict how likely you are to shop around for a better price. If their data suggests you're a loyal customer, meaning you're lazy or too busy to compare rates, their algorithm will flag you for a price increase. A small one at first, maybe 4% at your next renewal. You might not even notice it, or you'll just grumble and pay it because switching seems like a hassle. 6 months later, another little bump, 5%, then another. Over the course of 3, 4, or 5 years, these small incremental increases can add up to you paying hundreds and hundreds of dollars more than a brand new customer would pay for the exact same policy. Think about how insane that is. They are actively punishing you for your loyalty. They are banking on your inertia. They are squeezing their best, most stable customers because they know they can probably get away with it. It's a calculated gamble. They know some people will leave, but they also know that most people won't. And the extra profit they make from the millions who stay far outweighs the loss from the few who shop around. You have to understand this fundamental truth. Your insurance company is not your friend. They are not like a good neighbor. They are a publicly traded corporation with a legal fiduciary duty to their shareholders to maximize profit. And the primary way they do that is by charging you the absolute maximum price they believe you are willing to pay. Your goal, therefore, is to change their belief about what you're willing to pay. So how do we do that? We start with the single most powerful, most effective, and most fundamental weapon in your arsenal: comparison shopping. I know. Sounds boring. Sounds obvious. But I am telling you, it is the silver bullet. The vast majority of people, something like 80% of drivers, do not regularly compare their insurance rates. They sign up with a company, put the payments on autopay, and let it ride for years, all while the loyalty penalty is silently draining their bank account. You have to break that cycle. You have to treat buying car insurance like you're buying a plane ticket. You wouldn't just go to American Airlines website and buy the first ticket you see, right? Of course not. You'd go to Google Flights or Kayak, you'd compare all the airlines, and you'd find the best deal. You must apply that exact same logic to your insurance. Why is this so effective? Because every single insurance company uses a different secret formula, a different algorithm, to assess your risk. Company A might see your zip code in East LA and put a huge risk factor on it, jacking up your rates. But Company B might put more weight on your perfect driving record and your college degree, and see you as a much lower risk, offering you a dramatically lower price. You, the driver, haven't changed at all. The only thing that changed was the formula used to judge you. You will never know which company's formula favors you the most unless you check. I want you to think of it this way. Somewhere out there, right now, an insurance company is waiting to offer you a rate that is 30 to 40% lower than what you're currently paying. Your only job is to go find them. This isn't a myth. I have seen it happen thousands of times. A 40-year-old teacher in Sacramento with the same company for 12 years, thinking her loyal customer discount was a great deal. She spent 1 hour online comparing quotes. The result? She saved $1,100 a year. On an identical policy, that's almost $100 a month back in her pocket for 1 hour of her time. What's your hourly rate? I guarantee it's not $1,000. This is the starting point. This is square one. Before we even get into the specific discounts, the coverage tweaks, and the negotiation tactics, you must commit to this first step. Because everything else we're going to talk about is built on this foundation. You cannot negotiate from a position of power if you don't know what the competition is willing to offer you. Knowing your market value is your leverage. Without it, you have nothing. Now, simply shopping around is the first step, but how you shop is just as important. There are different ways to do it: going directly to company websites using online comparison tools, or working with different types of agents. And we're going to break down the pros and cons of each. But what's even more critical are the things you're not being told about your own risk profile. The factors that are secretly driving your rates up or down, completely behind the scenes. Things that have nothing to do with your driving. That's where the real magic and the real savings begin. Let's start with a person we'll call Jessica. Jessica lives in San Diego. She's a 35-year-old graphic designer, drives a reliable 2018 Honda Civic, and has a driving record so clean you could eat off it. No accidents, no tickets, not even a parking violation in the last decade. She commutes 20 minutes to work, parks in a secure garage, and considers herself the safest driver she knows. Yet, every 6 months her auto insurance bill arrives and it's a gut punch. It's hundreds of dollars more than what her friend David, who lives 2 hours north in Temecula, pays. David drives a similar car, has a similar job, and even got a speeding ticket 2 years ago. It makes no sense. Jessica has called her insurance company, shopped around on a few websites, and the answer is always the same. A shrug, a vague mention of local factors, and a premium that feels like a penalty. Jessica is falling victim to the invisible rulebook of auto insurance. She's being judged on a whole host of factors that have absolutely nothing to do with how she operates her vehicle. And until she understands these hidden metrics, she'll be stuck overpaying forever. The first, and for many people the most shocking factor, is your credit score. Now hold on. In California, there are specific regulations. Insurers can't use your credit score to deny you coverage or to cancel your policy. But, and this is a massive but, they absolutely can and do use a credit-based insurance score to help determine your premium. It's a slightly different model than the FICO score you use for a mortgage, but it's drawn from the same data in your credit report. Why on earth would your ability to manage a credit card have anything to do with your ability to merge onto the 405? The insurance industry's answer is based on one word: correlation. Decades of data analysis from these massive companies have shown them a strong statistical link between how people manage their finances and how likely they are to file a claim. The data suggests that individuals with lower credit scores tend to file more claims, more expensive claims, and are even more likely to commit insurance fraud. Whether you think that's fair or not is a whole other debate. Frankly, it doesn't feel fair at all. It feels like penalizing someone for having a tough financial year or for having medical debt. But right now, we're not here to debate the ethics. We're here to win the game. And to win, you have to know the rules. A poor credit-based insurance score can raise your rates by hundreds, sometimes even thousands of dollars a year, completely erasing the benefit of a perfect driving record. It's a silent killer of your budget. Later in this series, we'll talk about specific companies that weigh this factor less heavily. But for now, the first step is knowing where you stand. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. Get them. Scour them for errors. A mistake like a debt that isn't yours or a late payment that was actually on time could be costing you a fortune. Cleaning up your credit is one of the single most powerful things you can do to lower your insurance premium over time. The second secret factor is the one that's infuriating Jessica in San Diego: your zip code. This is arguably the most powerful factor in California. Insurers call it territory rating. They slice the state up into hundreds of tiny territories, and each one gets its own risk score. This score isn't based on you. It's based on everyone around you. It's based on the number of accidents, the number of claims for theft and vandalism, the cost of car repairs at local body shops, the frequency of lawsuits, and even the amount of traffic congestion in your specific neighborhood. This is why Jessica in a dense San Diego neighborhood pays more than David in a more spread-out part of Temecula. It has nothing to do with her driving. Her insurance company looks at her 92101 zip code and sees a higher frequency of fender benders, more vehicle break-ins, and higher labor costs for mechanics compared to David's 92591. She is, in the eyes of the algorithm, guilty by association. She's paying a risk tax for her neighbors. You could be the safest driver in the world, but if you live in an area with a high rate of insurance claims, you will pay more. Period. It's a brutal reality. Sometimes moving just a few blocks from one zip code to another can change your auto insurance premium by 10 or 20%. When you're shopping for a new apartment or a new house, it is absolutely worth getting insurance quotes for the addresses you're considering before you sign the lease or mortgage. It's a hidden cost of living that most people never think about until the first bill arrives. The third hidden factor is your occupation and even your level of education. Again, this feels deeply personal and wildly unfair. What does your job have to do with your driving? From the insurer's perspective, it's another game of statistics. Their data might show that engineers, scientists, and teachers as a group have fewer accidents than, say, delivery drivers, construction workers, or real estate agents. It's not a judgment on your character. It's a cold calculation based on massive data sets. They look at the daily routine. An office worker with a predictable commute is seen as a lower risk than a salesperson who is on the road all day, driving in unfamiliar areas under time pressure. A higher level of education, like a master's degree or a PhD, is also often correlated with lower rates. The algorithm assumes a certain lifestyle and level of risk aversion associated with these professions and academic achievements. When you get a quote online, And that little drop-down menu asks for your job title and education level. Don't just fly past it. It's not just for marketing data. It is actively being used to calculate your price. Be honest, but be specific. Selecting engineer might give you a better rate than selecting consultant, even if you do both. The fourth factor is your marital status. For decades, married people have paid less for auto insurance than single people. The stereotype of the settled down, responsible married driver versus the freewheeling single driver actually has a basis in actuarial data. Insurers' numbers show that married individuals file fewer claims. They are statistically less likely to be involved in late-night accidents or engage in risky driving behavior. So, when you get married, you should call your insurance agent the next day. It's often an instant discount. Conversely, if you get divorced, you may unfortunately see your rates go up, even if nothing else about your life or driving habits has changed. So let's look back at Jessica. Her perfect driving record is just one check mark on a long list. The insurer is also looking at her credit-based insurance score. They're looking at her dense, high-claim urban San Diego zip code. They're looking at her job as a graphic designer and her bachelor's degree. They're looking at her status as a single person. Each of these elements is a data point being fed into a complex algorithm. Her final premium isn't a reflection of her skill behind the wheel. It's a reflection of her total statistical profile. This is the secret world of insurance pricing. It's a world where your neighbor's fender bender, an old medical bill on your credit report, and your college degree can have as much impact on your rates as your own driving record. It's frustrating, it's confusing, and it feels like the game is rigged. But here's the good news. It's not just one game. There are over 100 different insurance companies playing this game in California, and they all have slightly different rulebooks. They all use these factors, but they don't all weigh them the same. One company might heavily penalize you for a lower credit score, but not care as much about your zip code. Another might be the exact opposite, offering great rates in urban areas, but being very tough on anyone without a perfect credit history. One company might give a huge discount to teachers, while another gives a bigger break to engineers. The key to unlocking the absolute cheapest auto insurance in California isn't just about being a good driver. It's about understanding your own unique risk profile, all of these hidden factors, and then finding the one company whose algorithm loves your specific combination of data. You're not just looking for a good insurance company, you're looking for your insurance soulmate. And in the next part, we're going to show you exactly how to find them. We'll break down which types of companies favor which types of profiles, and how you can use this insider knowledge to make them compete for your business, forcing the price down to its absolute lowest point. Alright, let's pull back the curtain. The first secret you need to grasp is that the auto insurance industry isn't one giant marketplace. It's actually 3 different battlegrounds, each with its own set of rules, its own champions, and its own ideal customer. If you're shopping on the wrong battleground, you are, without a doubt, leaving hundreds, maybe even thousands of dollars on the table every single year. Your job is to identify which battleground is built for you. Let's call these the 3 tiers of insurance. Tier 1 is the legacy giants. These are the names you know, the ones that saturate your TV with commercials and sponsor football stadiums. We're talking about State Farm, Allstate, Farmers, Geico, and Progressive. These companies are the Goliaths of the industry. They've been around forever, they have massive marketing budgets, and they've built their empires on a specific model: broad appeal and customer loyalty, often through bundling. Their strength is their infrastructure. They have thousands of local agents, massive call centers, and sophisticated apps. They want to be your one-stop shop. They desperately want to sell you not just your auto insurance, but your homeowners or renters insurance, your life insurance, even your pet insurance. Why? Because a bundled customer is a sticky customer. The more policies you have with them, the less likely you are to go through the hassle of leaving. So, who wins with a Tier 1 company? They are often the best fit for the ideal family profile. If you own a home, have a couple of cars, a clean driving record, and maybe a teenage driver you need to add to the policy, these guys are built for you. Their bundle discounts can be genuinely significant, sometimes making their combined price unbeatable. If you value having a local agent, someone you can sit down with face-to-face to discuss your coverage, then this tier is where you'll find that service. But here's the insider secret. Their size is also their weakness. Because they're trying to appeal to everyone, they can't be the cheapest for everyone. Their massive overhead, all those commercials, agents, and office buildings, has to be paid for, and it's baked right into your premium. If you're a single person with a perfect driving record just looking for a simple, no-frills liability policy, you're likely overpaying with a legacy giant. You're subsidizing their massive marketing machine and the agent network you might never even use. And if you have a less than perfect record, a DUI and at-fault accident, the Goliaths can be brutally expensive, because their pricing models are often less forgiving. They want the safe, predictable customer, and they price accordingly. This brings us to Tier 2, the digital disruptors. These are the tech-savvy upstarts and online-only players. Think of companies like Esurance, Root, Metromile, and a host of others you've probably seen advertised on social media. Their entire business model is the polar opposite of Tier 1. They slash overhead to the bone. No fancy corner offices, no army of local agents. Their headquarters are often in a single building, and their agents are a website, a mobile app, and a customer service chat box. Their game is data. They use technology to get a much more granular picture of who you are as a driver. Their secret weapon is something called telematics. This is the technology that uses your smartphone or a small device you plug into your car to track your actual driving habits. Are you a hard breaker? Do you accelerate like you're at the drag strip? Do you drive late at night? How many miles do you actually drive? Who wins with a Tier 2 company? First, the tech-savvy, low-mileage driver. If you work from home or take public transit and only use your car for weekend errands in California, a pay-per-mile insurer like Metromile could cut your bill in half, or even more. You're only paying for what you use. Second, the demonstrably safe driver. If you know you're a good driver, you're smooth on the pedals, you obey speed limits, you don't text and drive. A company like Root can be a goldmine. They'll literally give you a quote based on a test drive, using your phone's GPS and sensors. If you prove you're safe, they'll reward you with a rate that the legacy giants, who are just looking at your zip code and credit score, simply can't match. The downside? It's the trade-off for the low price. The customer service can be impersonal. If you have a complex claim, you won't be talking to a local agent who knows your name. You'll be navigating a call center or an app. And for some, the idea of an insurance company tracking their every move is a major privacy concern. If you're someone who values personal relationships and hates dealing with automated phone systems, this tier might not be for you, no matter how cheap it is. Now for the tier where the true hidden gems are often found. This is where you can find some of the absolute cheapest auto insurance in California, if you fit the profile. This is Tier 3, the niche specialists and regional champions. These companies don't even try to be everything to everyone. They do one thing and they do it exceedingly well. They survive and thrive by being laser-focused on a very specific type of customer or a specific geographic area. They have tiny marketing budgets and often grow by word of mouth and their reputation for low rates among their target audience. In California, a classic example is Wawanesa. Many people outside of the West Coast have never even heard of them. Wawanesa is hyper-focused on one thing: a good driver discount. They have some of the most stringent underwriting requirements in the state. They don't want the driver with a recent ticket. They don't want the driver with an at-fault accident. They want the squeaky clean, responsible driver, and they reward that person with rates that are often jaw-droppingly low, frequently beating the legacy giants and digital disruptors by a huge margin for that specific profile. Another example is Mercury Insurance. While they are a larger company, they have a deep-rooted history in California and have developed pricing models that are intensely competitive for a wide range of drivers within the state, often outpricing the big national brands. Or think about AAA of Southern California. They aren't just a roadside assistance company. They are a formidable insurance provider. But their best rates are reserved for their members who live in their specific territory. Who wins in Tier 3? The person who perfectly matches the company's niche. Are you a teacher? There are insurance companies specifically for educators that can offer incredible rates. A military member or veteran. USAA is legendary for its low prices and stellar service, but it's only available to that specific group. Are you that driver with a 20-year unblemished record? A company like Wawanesa might see you as a unicorn and price your policy accordingly. The challenge with this tier is discovery. You won't see these companies running Super Bowl ads. You have to actively seek them out. Many of them work through independent insurance agents. Not the captive agents like State Farm who can only sell one brand, but independent agents who can quote you from a dozen different companies, including these specialists. So you see, it's not about finding the one best insurance company. It's a matchmaking game. The 55-year-old homeowner with 2 cars and a boat will likely find their best deal in Tier 1. The 25-year-old software engineer who works from home and drives a Tesla might find a ridiculously low rate in Tier 2. And the 40-year-old teacher with a perfect driving record could find their cheapest possible rate with a Tier 3 specialist they've never even heard of. Understanding these 3 tiers is the foundational step. It changes your perspective from who has the cleverest commercial to which of these business models was designed for a person exactly like me. Now that you know the 3 battlegrounds where insurance companies fight for your dollar, the next step is to weaponize your own information. Before you get a single quote, before you even type your name into a website, you need to build what I call your driver dossier. This is the complete, accurate, and optimized profile of you as a risk. And in the next part, I'm going to show you exactly how to assemble it piece by piece, so that when you present yourself to these companies, you're positioned to receive their absolute best rock-bottom price. This is your pre-game, your training camp. What we're about to do is build your insurance resume. Think of it exactly like that. When you apply for a job, you don't just walk in and say, "Hey, I'm a person, give me a job." No, you hand them a polished resume that highlights your strengths, lists your qualifications, and presents you in the best possible light. We're going to do the exact same thing, but for auto insurance companies. We are going to meticulously craft a profile that makes their underwriting algorithms light up with green flags. Let's start with the most important part of this profile. You, the driver. This is where the insurance company starts its evaluation, and it's where we need to be crystal clear. First up, your personal details. Your age, your marital status, your address. Now, you can't change your age, but you need to understand how they see it. Drivers under 25, especially males, are statistically the riskiest group, so they face the highest rates. As you move into your 30s, 40s, and 50s, rates typically drop, assuming a clean record. Being married can also lower your rates. Why? Because actuaries have determined that married individuals, on average, exhibit safer driving behavior and have fewer claims. It suggests a more stable, risk-averse lifestyle. So if you're married, make sure that's on your application. Now, the absolute king of all rating factors, especially here in California, your driving history. This is your report card. It is the single most powerful lever in determining your premium. A clean record is like having a perfect 850 credit score in the lending world. It's gold. Your driving record, or motor vehicle record, the MVR, is a detailed history of every moving violation, every at-fault accident, and every point on your license. In California, most minor violations, like a speeding ticket, will stay on your record and impact your rates for 3 years. More serious offenses, like a DUI or a reckless driving charge, can haunt you for up to 10 years. So, the first piece of homework is to know exactly what's on your MVR. Don't guess. Don't assume. Go to the California DMV website and order a copy of your own driver record. It costs a couple of bucks, and it is the best money you will ever spend in this process. This allows you to see yourself exactly as the insurance companies see you. You'll see the exact violation dates, which is critical, because you'll know precisely when a ticket is set to fall off your record and no longer impact your rates. If you're just a month away from a ticket aging past that 3-year mark, you should wait to shop for new insurance. Waiting just 30 days could save you hundreds of dollars a year. If you did get a ticket and were eligible for traffic school and you completed it, double-check that the point was properly masked on your record. Mistakes happen. Next, let's talk about something that causes a lot of confusion in California: your credit score. In many states, your credit score is a massive factor. Insurers use it to create an insurance score, believing that people who are responsible with their finances are also responsible behind the wheel. But California is different, thanks to a law called Proposition 103. This law mandates that auto insurance rates must be based primarily on factors within your control as a driver. Specifically, the top 3 factors must be, in order, your driving safety record, the number of miles you drive annually, and your years of driving experience. Your credit history can be used, but its influence is legally limited and cannot be the primary reason you're given a higher rate. So, while having a good credit history is never a bad thing for your overall financial health, don't sweat it nearly as much as someone in Texas or Florida would. In California, your actions behind the wheel matter infinitely more. Now let's move on to the second part of your profile: the vehicle itself. What you drive is a huge piece of the puzzle. The make, model, and year of your car directly influence the cost of 2 key coverages: collision and comprehensive. Collision covers repairs to your own car if you hit something, and comprehensive covers theft or damage from things like fire, hail, or vandalism. Think about it from the insurer's perspective. Are you insuring a 10-year-old Honda Civic or a brand new Mercedes-Benz? The Mercedes has parts made of exotic materials that have to be shipped from Germany. Its bumper might have a dozen complex sensors embedded in it. A minor fender bender could easily result in a $10,000 repair bill. The Honda's parts are plentiful, domestic, and cheap. The repair bill for the same accident might be 1/10 of the cost. The insurer knows this, and your premium will reflect it. It's not just repair costs, it's also about theft rates. Certain cars are stolen far more often than others. Models like the Honda Accord and Civic or full-size Ford and Chevy trucks are consistently at the top of the most stolen vehicles list. If you own one of these, the comprehensive portion of your premium will be higher because the risk of a total loss theft claim is greater. And then there's safety. Insurance companies love safety. The Insurance Institute for Highway Safety, or IIHS, performs extensive crash testing on vehicles and gives out top safety pick awards. Cars that perform well in these tests, protecting their occupants and preventing accidents in the first place, often earn their owners a discount. Why? Because if you're less likely to be seriously injured in a crash, the potential payout for medical claims, the most expensive part of any accident, goes way down. So, for your insurance resume, you need to list out your vehicle's specs. And I mean every single one. Does it have anti-lock brakes? Yes. Driver and passenger airbags? Yes. Side curtain airbags? Yes. Electronic stability control? Daytime running lights? List them all. Then list your anti-theft features. Do you have a passive alarm that arms itself automatically? Or an active alarm you have to press a button for? Do you have a vehicle recovery system like LoJack? Every single one of these can translate into a specific discount. Don't assume the insurance company knows what your car has. You need to tell them. Finally, let's build the third part of your profile, your usage. This is how, where, and when you use your car, and in California it's a heavyweight factor right behind your driving record. The single biggest piece of this is your annual mileage. How many miles do you drive per year? Insurers see a direct correlation. The more you're on the road, the more exposure you have to a potential accident. Most companies have tiers. For example, driving under 7,500 miles a year might put you in a preferred low-mileage category. 7,500 to 12,000 might be standard, and over 15,000 puts you in a higher-risk tier. You need to calculate this number honestly and accurately. Don't just pull a number out of thin air. Dig up your last 2 service records and look at the mileage. Subtract the older number from the newer one to see how much you drove in that period, and then calculate your annual average. Or use Google Maps to calculate the round-trip distance of your daily commute, multiply it by the number of days you work a week, and then by the number of weeks you work a year. Add a couple thousand extra miles for errands and trips. Lying about your mileage is a bad idea. If you claim you only drive 5,000 miles a year but then get into an accident 200 miles from home 6 months after your policy started, they're going to ask questions. It's considered material misrepresentation and could lead to a claim being denied or your policy being canceled. You also need to define the primary use of the vehicle. Is it for commuting to work or school? If so, what's the one-way distance? Is it just for pleasure or recreation, meaning you don't use it for a regular commute? Or is it for business, like making sales calls or deliveries? Business use is the most expensive, so be sure you're classifying it correctly. Driving to and from a single place of work is commuting, not business use. And a critically important piece of the usage puzzle, your garaging address. This is the zip code where your car is parked most of the time, usually your home address. Insurers track claim data, accidents, theft, vandalism, even weather-related claims like flooding, down to a specific zip code. A zip code in a dense urban area with high traffic and higher crime rates will have higher base rates than a sleepy, rural zip code a few miles away. Moving from San Francisco to a suburb like, so now you have your weapon. Your source of truth document is organized, accurate, and ready for battle. This is the moment where preparation meets opportunity, and it's what separates the people who think they're getting a good deal from the people who know they're getting the absolute lowest price possible. The market is a confusing place designed to be that way, but we're going to cut through the noise by understanding the 3 main channels you can use to buy insurance, and more importantly, how to play them against each other for your benefit. Think of it like this: you need a new pair of running shoes. You could go to the Nike store, you could go to a big shoe store like Foot Locker, or you could go online to a site like Zappos. Each has its pros and cons, and each might have a different price for the exact same shoe. Auto insurance is no different. The first channel is the captive agent. This is what most people think of when they picture an insurance agent. These are the folks who work for one and only one company, Your local State Farm agent, your Allstate agent, your farmer's agent, these are all captive agents. Their entire world revolves around the products, pricing, and rules of that single company. The benefit of a captive agent is deep product knowledge and, often, a personal relationship. They know their company's discounts inside and out. They know how to package a home and auto policy for the maximum discount that their company offers. If you have a claim, you have a specific person to call who can advocate for you within that company's system. The downside, however, is significant. They can only sell you Nike. If Adidas is having a massive sale or if Reebok just released a shoe that's a much better fit for your foot, the captive Nike agent can't tell you about it. They can't even offer it. Their loyalty is by design to their company first. They are a captive of that brand. So while they can be a great resource, relying solely on a captive agent is like walking into a single car dealership and assuming they have the best deal on the best car for you in the entire city. It's possible, but it's not probable. The second channel is the independent agent, also known as an insurance broker. This is your Foot Locker. An independent agent doesn't work for one single insurance company. Instead, they have appointments or contracts with multiple carriers. They might represent Progressive and Travelers and Mercury and Safeco, and a dozen other companies you've maybe never even heard of. The huge advantage here is choice. You walk into their office and using your source of truth document, you give them your information one time. They then go out and shop it across their entire portfolio of insurance companies to find the best fit for you. They can compare the different coverages and prices from multiple carriers side by side. An independent agent's job is to find you the best value in their market. They can often find incredible deals with smaller, regional carriers that don't have billion-dollar advertising budgets and therefore can offer more competitive rates. The potential downside? They don't represent every company. They won't have access to State Farm or Allstate, for example. And while their loyalty is supposed to be to you, the client, it's important to remember they are still paid by commission from the insurance companies. It's a subtle but important distinction. They are your professional shopper, but they're shopping from a collection of stores they have a relationship with, not every store in the mall. Finally, the third channel is direct-to-consumer. This is your Zappos or Amazon. These are the companies like Geico and Progressive who have spent fortunes convincing you that you can save money by cutting out the middleman, the agent, and buying directly from them online or over the phone. The primary appeal is speed, convenience, and the perception of lower cost. You can get a quote in 15 minutes from your couch at 10 p.m. Because they don't have to pay commissions to a vast network of agents, their overhead can be lower, and in theory they pass those savings on to you. This is often true for drivers with clean records and straightforward needs. You are in complete control of the process. The disadvantage is that you are in complete control of the process. There is no expert to guide you. If you don't understand the difference between liability limits, or what uninsured motorist coverage really does, it's on you to figure it out. When you have a claim, you're not calling your local agent, you're calling a 1-800 number and speaking to a different person in a call center every single time. You are your own agent for better or for worse. So we have the three channels: captive, independent, and direct. Most people make a massive mistake. They pick one. They call the agent their parents used, or they go to the website they see advertised during the Super Bowl and they stop there. This is like leaving hundreds, if not thousands, of dollars on the table. Here is the strategy that will virtually guarantee you find the lowest rate you qualify for. We call it the trifecta quoting method. It's simple. You are going to get a quote from each of these three channels. You will force them to compete for your business. First, you are going to identify and call a major captive agent in your area. Look up a highly rated local agent for State Farm or Farmers. Call them and, using your source of truth document, give them your information and ask them for their best possible quote. Second, you are going to find a well-established, highly reviewed independent insurance agency in your town. You can search online for independent auto insurance agent near me. Call them up and do the exact same thing. Provide them with the information from your source of truth document and ask them to shop their carriers for the best option. Third, you are going to go online yourself and get quotes directly from at least 2 major direct-to-consumer carriers. I would recommend starting with Progressive and Geico, as they are often the most competitive in the direct space. Go to their official websites, and this is critical, their official websites, not some third-party lead generation site, and meticulously fill out their online quote forms using the exact same information from your source of truth document. Let me pause on that for a second because it's a huge pitfall. Be very careful of websites that promise to compare 20 quotes in 2 minutes. These are almost never actual insurance companies. They are lead generation farms. You put in your name, phone number, and email, and they sell that information to a dozen hungry agents who will then proceed to blow up your phone and inbox for the next 6 months. A real insurance company website like Progressive.com or Geico.com will have its branding all over it and will give you a quote directly from them. A lead gen site is vague and is primarily focused on getting your contact info. Avoid them at all costs. By following the trifecta method, you are creating a comprehensive market analysis. The captive agent will give you the best rate their one company can offer, including any unique package discounts. The independent agent will scan a wide array of other carriers, potentially uncovering a gem from a smaller company. And the direct writers will give you their lean, algorithm-based price, which is often the most competitive for standard drivers. You are using your source of truth document as the control in this experiment. Every single quote you receive will be based on the exact same driver profiles, the exact same vehicles, the exact same driving history, and the exact same coverage requests. This is how you get a true apples-to-apples comparison. There's no guesswork. You're not telling one agent you drive 10,000 miles a year and another you drive 12,000. You are a data-driven, systematic shopper. This process might take you an afternoon, but that afternoon of work could easily save you $1,000 or more over the next year. You will know with a high degree of certainty that the price you ultimately choose is the lowest price available to you across the entire market. You've covered all your bases. Now you have a process. You're going to gather these quotes from the captive agent, the independent agent, and the direct writers. You'll have a small stack of numbers in front of you, but getting the quotes is only half the battle. A low price can hide some dangerous traps. A cheap policy isn't a good deal if it leaves you financially ruined after an accident. In the next part, we're going to dissect these quotes line by line to find out what you're really paying for, and more importantly, what dangerous coverage gaps you need to avoid. Alright, let's pull up a sample quote. When you get one, whether it's online or from an agent, you're looking at a document called the declarations page. Think of it as the cheat sheet for your entire policy. It lists you, your car, and most importantly, your coverages and their limits. This is where the magic and the mistakes happen. We're going to break this down section by section, starting with the absolute most important part: liability coverage. This isn't for you. Let me repeat that. Liability coverage does not pay for your injuries or your car. It pays for the damage you do to other people and their property. This is the coverage that's legally required in California, and it's the one that protects you from a lawsuit that could wipe you out financially. You'll see it listed with 3 numbers, separated by slashes. The California state minimum is 15/30/5. Let's translate that from insurance speak into plain English. The first number, 15, stands for $15,000. That is the maximum amount your insurance will pay for any single person's bodily injury in an accident you cause. The second number, 30, is $30,000. That's the maximum total your policy will pay for all bodily injuries combined in a single accident. So if you injure 3 people, they have to share that 30 grand. The last number, 5, is $5,000. That's the maximum your policy will pay for all property damage you cause. This means the other person's car, or maybe a mailbox, a fence, a storefront, anything you hit. Now, I want you to pause and really think about those numbers. $15,000 for a person's medical bills, $30,000 total, and only $5,000 to replace or repair someone's car. Does that sound like enough money in today's world? Imagine you're on the 101 and you cause a minor fender bender. The other car is a brand new SUV. A modern bumper with sensors and cameras can easily cost $3,000 to $4,000 to replace. Add in a new headlight assembly, some bodywork, and a rental car for the other driver, and you've blown past your $5,000 limit before the tow truck even arrives. And that's just a fender bender. What if it's a serious accident? A single trip to the emergency room with an ambulance ride can exceed $15,000. If someone needs surgery, an extended hospital stay, or physical therapy, their bills could be in the hundreds of thousands of dollars. Once your insurance policy pays out its maximum limit, that tiny $30,000, where do you think the rest of the money comes from? Comes from you. They can sue you personally. They can go after your savings, your investments, and in some cases, they can garnish your future wages for years. Choosing the state minimum is like bringing a squirt gun to a wildfire. It's the single biggest mistake people make when trying to save money. A much safer and smarter starting point for most people is 100/300/50. That's $100,000 per person, $300,000 per accident, and $50,000 for property damage. Yes, it will cost more than the state minimum, but the increase in your premium is often shockingly small for the massive increase in protection you get. This is the difference between a car accident being a bad day versus a life-altering financial catastrophe. Okay, moving down the declarations page, you'll see a section called uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. This is the flip side of liability. This coverage protects you when you're hit by someone who either has no insurance at all, or who has those pathetically low state minimum limits we just talked about. Let this sink in. According to the Insurance Research Council, about 1 in 7 drivers in California is completely uninsured. That's a massive number. You are sharing the road every single day with people who are breaking the law and have zero ability to pay for the damage they might cause you. This is where UM/UIM becomes your shield. If an uninsured driver T-bones you in an intersection and puts you in the hospital, your uninsured motorist bodily injury coverage steps in to pay for your medical bills, your lost wages, and your pain and suffering up to your policy limit. Underinsured motorist kicks in when the at-fault driver has insurance, but their low liability limits aren't enough to cover your bills. Your policy will pay the difference, again, up to your limit. A good rule of thumb is to match your UM/UIM limits to your own liability limits. If you have 100/300 in liability, you should have 100/300 in UM/UIM. The logic is simple. Why would you want to provide less protection for yourself and your family than you provide for a total stranger? This coverage is typically very affordable, and declining it to save a few bucks a month is a huge gamble. Next up, you'll likely see medical payments coverage or MedPay. California is an at-fault state, so we don't have the personal injury protection or PIP that you might hear about from other states. MedPay is simpler. It helps pay for your medical or funeral expenses if you or your passengers are injured in an accident, regardless of who is at fault. You might be thinking, but I have health insurance, why do I need this? That's a great question. MedPay can be incredibly useful for covering things your health insurance might not, like high deductibles, copays, or ambulance fees. It also extends to your passengers, who might not have health insurance of their own. It provides immediate payment, so you're not waiting for a fault determination or a settlement to get your bills paid. Having even a modest amount, say $5,000 in MedPay coverage, can be a lifesaver for handling those immediate out-of-pocket costs after a crash. Now we get to the part that's about fixing your car. Collision and comprehensive coverage. These are often lumped together, but they cover two very different things. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That usually means another car, but it also includes things like hitting a pole, a tree, or even a curb that messes up your alignment and suspension. Pays out regardless of who is at fault. Comprehensive coverage, sometimes called other than collision, is for almost everything else. Think of it as the act of God or bad luck coverage. It covers your car if it's stolen, vandalized, catches on fire, or is damaged by things like falling objects, hail, floods, or hitting an animal. Here's the key thing to understand about both collision and comprehensive: the deductible. The deductible is the amount of money you have to pay out of pocket for a claim before your insurance company starts paying. For example, if you have a $500 deductible and you have $3,000 worth of damage to your car, you pay the first $500, and your insurance pays the remaining $2,500. This is your primary tool for managing your premium cost. A lower deductible, like $250, means you pay less out of pocket, but your monthly premium will be higher. A higher deductible, like $1,000 or $1,500, means your premium will be significantly lower, but you're on the hook for more of the cost if you have a claim. So which one should you choose? The golden rule for deductibles is this: set it to the highest amount you could comfortably pay tomorrow right now without causing a financial crisis. If writing a check for $1,000 would be a major hardship, don't choose a $1,000 deductible. But if you have a healthy emergency fund, raising your deductible from $500 to $1,000 could save you a substantial amount on your premiums over the year after year. Finally, do you even need these coverages? If your car is financed or leased, the answer is yes. Your lender will almost certainly require you to carry both. But if you own your car outright and it's an older, lower value vehicle, you have a choice. A good guideline is to consider dropping collision and comprehensive if the annual cost of the coverage is 10% or more of your car's actual cash value. If your car is only worth $4,000 and you're paying $500 a year for these coverages, it might be time to consider self-insuring and just banking that premium money instead. So we've decoded the core of your policy: liability UM/UIM, MedPay, collision, and comprehensive. These are the big five that determine 90% of your protection. But when you look at a quote, you'll see a bunch of other little options and add-ons. Things like rental reimbursement, roadside assistance, and gap insurance. Are they worth it? Or are they just expensive fluff designed to pad the insurance company's profits? We're going to break down those bells and whistles next, to make sure you're only paying for what you truly need. Let's start with rental reimbursement. On paper, it sounds like a no-brainer. Your car is in the shop after an accident, and your insurance company pays for a rental car so you can still get to work, pick up the kids, and live your life. It usually only costs a few bucks a month, maybe $5 to $15. What could be wrong with that? Well, the devil, as always, is in the details. First, let's talk about the limits. Most standard rental reimbursement plans in California will cover something like $30 a day for up to 30 days. Now, I want you to pause and think about the last time you rented a car in Los Angeles, San Francisco, or even Sacramento. When was the last time you found a car, after all the taxes and fees, for only $30 a day? It's nearly impossible. A basic economy car will likely run you $50, $60, or even more per day. So even with this coverage, you're still paying $20 to $30 out of your own pocket every single day. That cheap add-on suddenly doesn't feel so comprehensive. But here's the bigger catch, the one that trips up so many people. Rental reimbursement only kicks in for a covered claim. Let's say your transmission fails or your engine blows. Your car is going to be in the shop for a week, maybe longer. You need a car to get around, but because it was a mechanical failure, not an accident or a covered event like a fire or theft, your rental reimbursement coverage is worthless. It won't pay a single dime. Here's another scenario. Someone runs a red light and plows into you. It's 100% their fault. Your car is totaled. In this case, it's the at-fault driver's insurance company that is responsible for paying for your rental car. Their property damage liability coverage should handle it. So you're paying for a coverage that you wouldn't even use in one of the most common accident scenarios. So, who should actually buy it? Think of it this way. If you're a one-car household and losing that car for a week or two would be a complete catastrophe, preventing you from earning a living, then yes, that $10 a month might be worth the peace of mind. It's a safety net, albeit a small one. But if you have a second car in the family, if you work from home, if you have easy access to public transit, or if you have enough in your emergency fund to cover a rental for a week without breaking a sweat, you can probably skip this one. You're essentially prepaying for a problem you might never have, and for a solution that only partially solves it. Next up, roadside assistance. This is the one that seems too good to pass up. It's often incredibly cheap, sometimes just $1 or $2 a month to add to your policy. A flat tire on the 405? Dead battery in a parking lot in Bakersfield? Locked your keys in the car in front of a restaurant in Napa? Just call the number on your insurance card, and help is on the way. It's a fantastic service, but here's the million-dollar question. Are you already paying for it somewhere else? This is what I call the duplication trap. Before you add this to your policy, you need to do a quick audit of your life. First, do you have AAA? If you're a member of the American Automobile Association, you already have one of the best roadside assistance programs on the planet. Adding it to your insurance is completely redundant. Second, check your wallet. Take out your credit cards. Many premium cards, like an American Express Platinum or a Chase Sapphire Reserve, include complimentary roadside assistance as a perk of membership. You're already paying an annual fee for that card. You might as well use the benefits. Third, what kind of car do you drive? If you bought your car new within the last few years, chances are it came with a multi-year roadside assistance plan directly from the manufacturer. Honda, Toyota, Ford, Chevy, they all offer it. Check your owner's manual or the paperwork from when you bought the car. You could be covered for another year or two without even realizing it. But there's an even more important, almost secret reason to be cautious. When you use the roadside assistance provided by your auto insurer, it can sometimes be logged on your insurance record as a claim. Now it's typically a $0 or non-chargeable claim, so it won't directly raise your rates. However, insurance companies are all about data and patterns. If they see you've called for a tow twice and a jumpstart once in the last 2 years, a computer algorithm somewhere might flag you as a slightly higher risk. It could contribute to a higher premium at renewal time. When you use a third-party service like AAA, your auto insurance company knows nothing about it. It has zero impact on your insurance risk profile. So the verdict is this. For the vast majority of people, roadside assistance through your insurer is an unnecessary expense. Check your other memberships, credit cards, and car warranty first. If you have absolutely no other coverage, Then for $1 a month, it's a cheap safety net. Just be aware that using it isn't entirely without potential consequences. Finally, we arrive at the big one, gap insurance. This is arguably the most important and most misunderstood add-on of them all. And getting this one wrong can cost you thousands of dollars. Let me tell you a quick story about a driver we'll call Alex from Fresno. Alex just got a great new job and decided to treat himself to a brand new SUV. It cost $40,000. He was so excited he only put a little bit of money down, about $1,000, and financed the rest over 72 months. The dealership, of course, tried to sell him gap insurance for $900, but he said no, trying to save money. 1 year later, driving on Highway 99, someone makes an illegal lane change and Alex's beautiful new SUV is totaled. Everyone is okay, thankfully. His collision coverage kicks in, and his insurance company assesses the value of his 1-year-old SUV. Because of depreciation, that massive drop in value the second a new car leaves the lot, they determine its actual cash value is now only $32,000. That's the check they cut him, minus his deductible. Here's the problem. Alex has been making payments for a year, but because of interest, he still owes the bank $37,000 on his loan. So, he gets a check for $32,000 from his insurance, but he owes $37,000. That's a $5,000 difference. That is the gap. Without gap insurance, Alex now has no car, and he has to write a check to the bank for $5,000 for a vehicle that is sitting in a scrapyard. It's a financial nightmare. Gap insurance is designed to pay off that exact difference, making you whole with the lender. So, who needs it? You absolutely should have it if you put less than 20% down on a new car. You need it if you financed your car for 60 months or longer. You need it if you rolled negative equity from a previous trade-in into your new car loan. And you need it if you drive a model of car that is known to depreciate quickly. But here is the single most important piece of advice I can give you about gap insurance. Do not buy it from the car dealership. The finance manager at the dealership will present it to you as a simple, convenient option. But they will mark it up by an astronomical amount, often charging $700, $800, or even more. And worse, they'll roll that cost into your car loan so you'll be paying interest on it for years. Instead, the moment you decide to buy the car, call your auto insurance agent or go online. You can almost always add gap coverage directly to your auto policy for a tiny fraction of the cost. We're talking maybe $5 or $6 a month. That's about $72 a year, versus the $900 the dealership wanted. And here's the pro tip to save you even more money. Gap insurance is not a set-it-and-forget-it coverage. The day will come when you no longer need it. Every 6 months or so, go to a site like Kelley Blue Book and check the current market value of your car. Then, check your auto loan statement to see your remaining balance. The moment your car is worth more than what you owe, you are no longer upside down, and the gap no longer exists. That is the day you call your insurance company and tell them to remove the gap coverage from your policy. It's pure savings from that point forward. So to recap, rental reimbursement is for specific, high-risk situations. Roadside assistance is usually redundant, and gap insurance is a financial lifesaver for new car loans, as long as you buy it cheap and cancel it the second you don't need it. We've dissected the policy, we've trimmed the fat. You now know what coverage you need and what you can skip. But the price you pay for that exact same coverage can vary by $1,000 or more depending on one thing: the company you choose. In the next part, we're diving deep into the biggest insurance players in the Golden State. We'll uncover the secrets of their pricing, their customer service reputations, and reveal which companies are often the best bet for California drivers. Alright, let's pull back the curtain on the titans of California auto insurance. When you start shopping for a policy, you're going to see the same handful of names pop up again and again. These are the heavyweights, the giants who control the vast majority of the market. We're talking about State Farm, Geico, Progressive, Farmers, AAA, and a big California-specific player, Mercury. Each one of these companies has a distinct personality, a different strategy for winning your business, and a different type of driver they secretly love the most. Understanding their game is the key to playing it better than they do. Let's start with the biggest of them all, State Farm. Their slogan, like a good neighbor, State Farm is there, isn't just marketing fluff. It's their entire business model. State Farm operates through a massive network of local agents. These are the people with offices on Main Street, the ones who sponsor the local Little League team. When you buy a policy from them, you're not just buying insurance, you're buying a relationship with a specific person. If you get into an accident, you call your agent, not an anonymous 1-800 number. For millions of people, that human connection is worth everything. So what does this mean for pricing? It means State Farm is rarely the absolute rock-bottom cheapest option. They have to pay for all those agents and all those physical offices. That overhead gets baked into your premium. However, they are incredibly competitive, especially for their target customer, the family. If you own a home, have multiple cars, maybe a life insurance policy, and a relatively clean driving record, State Farm wants you. Their bundling discounts are some of the best in the business. By combining your home or renter's insurance with your auto policy, their price can suddenly become very, very attractive. In terms of customer service, J.D. Power consistently ranks them at or near the top for claim satisfaction. When things go wrong, having that local agent in your corner can be a massive stress reliever. So if you're someone who values service and advice over a purely digital experience, and you have other assets to insure, State Farm should be one of your first calls. Now let's pivot to the complete opposite end of the spectrum. Geico. The friendly gecko represents a revolution in the insurance industry. Their entire model is built on one idea: cut out the middleman. No agents, no fancy local offices. It's a direct-to-consumer machine, and that machine is designed for speed and efficiency. Their famous promise, 15 minutes could save you 15% or more, is a direct shot at the traditional, slower agent model. Their strategy is to slash overhead costs to the bone and pass those savings on to you. And for a huge number of Californians, it works. Geico is often one of the cheapest insurers in the state, particularly for drivers with good credit and clean driving records. They love single drivers, young professionals, and anyone who is comfortable managing their entire life through an app. Their mobile app is one of the best in the industry, allowing you to pay bills, access ID cards, and even file a claim without ever speaking to a human. The trade-off, of course, is the lack of personal touch. When you have a problem, you're calling a massive call center. While their service is generally rated as good and efficient, you are a policy number in a highly optimized system. There's no one who knows your name or your history. If you are a self-sufficient, tech-savvy driver whose number one priority is a low monthly payment, Geico is an absolute must-quote. Next up is Progressive. If State Farm is the friendly neighbor and Geico is the efficient machine, Progressive is the data scientist. For decades, they have been the industry's leading innovator. They were one of the first to offer quotes online and to directly compare their rates against their competitors. They are obsessed with data, and their number one tool for collecting it is Snapshot, their telematics program. This is the little device you plug into your car or the app you use on your phone that tracks your actual driving habits. How much you drive, when you drive, and how hard you brake. This data-driven approach makes Progressive's pricing incredibly dynamic. If you're a safe, low-mileage driver who can prove it with Snapshot, you can get a fantastic rate. But here's their other secret. Progressive is often more willing than other mainstream carriers to insure higher-risk drivers. Have an accident or a ticket on your record. While Geico or State Farm might show you the door or a sky-high premium, Progressive will often still offer you a policy. It won't be cheap, but it might be your best option. They use their vast pools of data to price that risk more accurately than anyone else. Customer service can be a bit of a mixed bag. Their digital tools are top-notch, but the call center experience can vary. Progressive is the best bet for drivers willing to share their driving data for a discount, and for those with a few blemishes on their record, who need a major carrier to give them a chance. Now let's talk about a California institution, AAA. Technically, it's two separate entities: the Automobile Club of Southern California and CSAA for Northern California. But their value proposition is the same. With AAA, you're not just buying an auto insurance policy. You're buying into an ecosystem of trust. People join for the legendary roadside assistance and stay for everything else: DMV services, travel discounts, and yes, insurance. Their pricing model is unique. You have to be a member to even get a policy, so you have to factor in that annual fee. But for members, their rates can be surprisingly competitive, especially when you consider the value of the entire package. Where AAA truly shines, however, is customer service. Year after year, in study after study, they are ranked at the absolute pinnacle of customer and claim satisfaction. People who have AAA insurance are fiercely loyal. They tell stories of claims being handled with incredible speed, compassion, and fairness. They're not always the cheapest on a pure premium-to-premium comparison, but if you factor in the value of their roadside service and the peace of mind that comes with best-in-class service, AAA presents a compelling case. They are ideal for drivers who see insurance as part of a larger relationship built on trust and service, not just a monthly bill. Then there's the hometown hero Mercury Insurance. While they operate in a few other states, Mercury is a California company through and through. They don't have the massive national advertising budgets of Geico or Progressive. Instead, they focus their energy on one thing: offering aggressively low prices right here in the Golden State. They work through a network of independent agents and have built a reputation as a no-frills, low-cost leader. For many Californians with clean driving records, a quote from Mercury will come in significantly lower than the big national brands. They understand the local market intimately and price their policies to win. But, and this is a big but, there's a trade-off. Historically, Mercury's weakness has been in customer service and claims handling. When you look at state-level data for customer complaints, Mercury often has a higher complaint ratio than its larger competitors. This doesn't mean every customer has a bad experience, not at all. But it does suggest a pattern. You might be getting a rock-bottom price, but if you need to file a claim, the process might not be as smooth as it would be with a top-tier provider like AAA. It's a calculated gamble. If your primary goal is to pay the absolute minimum required by law, and you're willing to risk a potentially more difficult claims process, Mercury is a company you have to check out. Finally, I want to let you in on a secret. It's a company you might not have heard of, but for a certain type of driver, they are the holy grail of cheap California auto insurance. The company is Wawanesa. They are a Canadian insurer with a presence in California and Oregon, and they have a cult following among savvy insurance shoppers. Their business model is simple. They only insure the best drivers. To get a policy with Wawanesa, you typically need a squeaky clean record. We're talking no at-fault accidents and no more than one minor ticket in the last 3 years. They are incredibly selective. Because they only insure the safest drivers, their pool of customers files far fewer claims. This allows them to offer rates that are, frankly, astonishingly low. It is not uncommon for a qualified driver to get a quote from Wawanesa that is 30, 40, or even 50% cheaper than the big-name competitors. And because they deal with fewer chaotic claims, their customer service is consistently ranked among the best in the state. They are the definition of a hidden gem. If you have a perfect or near-perfect driving record, you owe it to yourself to get a quote from Wawanesa. You might be shocked at what you find. So you see, there is no single cheapest company. It's a complex marketplace where each insurer is hunting for their ideal customer. State Farm wants the homeowner. Geico wants the self-sufficient digital native. Progressive wants the data sharer. AAA wants the loyalty-driven member. Mercury wants the price-sensitive Californian. And Wawanesa wants the perfect driver. Knowing who they are helps you know where you fit. But finding the right company is only half the battle. The other half is knowing exactly what to say and what to ask for when you get that quote. So you've picked your top 3 companies. You're ready to call them or fill out their online form. This is the moment of truth. And this is where 99% of people make their first and most expensive mistake. They ask for a quote on full coverage. Let me tell you a secret from inside the industry. Full coverage is not a real insurance term. It's a myth, a slang phrase. And when an agent hears you say it, a little light goes on in their head. It tells them you don't know the language. It tells them you can be sold a prepackaged, high-profit plan instead of a policy that's actually tailored to you. You've just unknowingly given up all your power. We're not going to do that. You are going to take control of this conversation from the very first second. You're not going to ask for full coverage. You are going to tell them with confidence exactly what you want line by line. You are going to build your policy from the ground up like a master architect, and in doing so, you will build in savings at every single step. Think of your auto insurance policy as having 3 main parts. Part 1 is your liability coverage. This is the non-negotiable, legal must-have part. It doesn't protect you or your car. It protects everyone else from you. If you cause an accident, this is the money that pays for the other person's car repairs and their medical bills. It's your financial shield. The state of California has a legal minimum. It's ridiculously low, something like $15,000 for a single person's injury. Let me be crystal clear. The state minimum is a financial trap. It's a ticket to bankruptcy. Imagine you cause a multi-car accident on the 405. The kind that happens every single day. A few modern cars, a couple of minor injuries. You will blow past that $15,000 limit before the tow trucks have even arrived. And once that insurance money runs out, guess who they come after for the rest? They come after you. Your savings. Your paycheck. Your house. So when you get your quote, you will not ask for state minimum. You're going to start by asking for liability limits of, at minimum, 100/300/100. Let's break that down. The first number, 100, means your policy will pay up to $100,000 for any single person's medical bills. The second number, 300, is the total it will pay for all injuries in a single accident. And that last number, 100, is the amount it will pay for property damage. That's for their car, the guardrail you hit, whatever. 100/300/100. That's your new baseline. For many people, this will barely cost more than the state minimums, but the level of protection it gives you is astronomical. It's the difference between a paper shield and a steel wall. Okay, that's part 1. You've protected your assets from the world. Now for part 2. Protecting your own car. This is where collision and comprehensive coverage come in. They are almost always sold together, and this is what people are usually thinking of when they say full coverage. Collision is simple. It pays to fix your car if you hit something, whether it's another car, a pole, or a wall. It's your fault, it's their fault, it doesn't matter. Collision fixes your car. Comprehensive is for almost everything else. Think of it as acts of God or acts of chaos. A tree branch falls on your car. Your car is stolen. A rock cracks your windshield on the freeway. It floods. It gets vandalized. That's comprehensive. Now, with both collision and comprehensive, you have to choose a deductible. This is the single most important number you will choose for controlling your price. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a single dime. They come in standard amounts, $250, $500, $1,000, even $2,000. And the rule is simple. The higher your deductible, the lower your monthly premium. So which one do you choose? The insurance agent will probably default you to a $500 deductible, but you're smarter than that. You need to ask yourself one simple, honest question. What is the largest check I could write tomorrow for a car repair without breaking a sweat or going into debt? If that number is $1,000, you should have a $1,000 deductible. If it's $500, then that's your number. Why would you pay a higher monthly premium for a lower deductible that you don't even need? If you have a healthy emergency fund, raising your deductible from $500 to $1,000 can save you 15 to 30% on this part of your premium. It's a massive, easy win. Just make sure you can actually afford to pay that amount if something happens. So, to recap, you've asked for 100/300/100 in liability. You've asked for collision and comprehensive. And you've specified a deductible that you are actually comfortable with. You've already built a better, cheaper policy than 99% of people on the road. But we're not done. Now we enter part 3, the optional coverages. This is where agents make a lot of their profit by bundling in things you may not need. But for some of us, these are vital. You just need to know what they are so you can make a conscious choice. First is medical payments or MedPay. This is a small amount of coverage, usually $1,000 to $5,000, that covers medical expenses for you and your passengers, no matter who is at fault. It's primary coverage, meaning it pays out before your health insurance does. Now, if you have amazing health insurance with a low deductible, you might not need this. But if you have a high deductible health plan, MedPay can be a lifesaver. It can cover that big health insurance deductible for you in the event of a car accident for just a few extra dollars a month. You have to decide if that peace of mind is worth it. Next, and this one is critical in California, uninsured and underinsured motorist coverage, or UM/UIM. I consider this non-negotiable. This protects you when you are hit by someone who has no insurance, or who has those garbage state minimum policies that won't even cover a fraction of your bills if you're seriously hurt. You are insuring yourself against the irresponsibility of others. California has one of the highest rates of uninsured drivers in the country. This coverage pays for your medical bills, your lost wages, your pain and suffering. Without it, you could win a lawsuit against the person who hit you, but what good is that if they have no money to give you? You can't get blood from a stone. Get uninsured motorist coverage. I recommend matching it to your liability limit, so get 100/300 here as well. Finally, there are the convenience coverages: rental car reimbursement and roadside assistance. Rental reimbursement is pretty straightforward. If your car is in the shop after a covered claim, it pays for a rental car. If you have a second car at home or can work from home, you can probably skip this and save the money. If you absolutely depend on your car every single day, it might be worth a few extra bucks. Roadside assistance is for lockouts, flat tires, and towing. It's great, but check to see if you already have it. Many new cars come with it. Your credit card might offer it. And if you have a AAA membership, you absolutely do not need to pay your insurance company for it again. Don't pay for the same service twice. Okay, your policy is now custom built. You've dictated the terms. The final step in the quote process is what I call the discount gauntlet. Do not wait for the agent to ask you if you qualify for discounts. You are going to run down a checklist with them. You're going to say, I just want to make sure we're applying every single discount I'm eligible for. And then you list them. Are you a member of a credit union or an alumni association? That could be an affinity group discount. Do you have a college degree? Some companies have a discount for that. Are you a teacher, a scientist, an engineer? There are professional discounts. Do you have a good student in your house? That's a huge one. Is your car equipped with anti-lock brakes and airbags? That's a safety feature discount. Are you bundling your auto with a home or renter's policy? That's the biggest discount of all. Did you take a defensive driving course? Are you a low-mileage driver because you now work from home? You go down the list and you make them check every single box. Each no is fine, but each yes is another 5 to 10% shaved off your total. By now, you've completely changed the dynamic. You're not a passive customer accepting a price. You are an informed consumer actively building the most efficient, cost-effective policy possible. You've armed yourself with the right language, the right numbers, and the right questions. You now have the exact blueprint to get a truly personalized quote from any company you call. But getting the quote is just one part of the final phase. Now you'll have 3, maybe 4 different quotes sitting in front of you, each with slightly different terms and confusing numbers. They don't make it easy to compare. How do you know which one is actually the best deal? And what's the one final move you can make right before you buy that can save you even more? We're going to break down that final comparison and reveal that last secret in our final part. Alright, you've done the hard work. You've gathered quotes from multiple companies, both big names and some smaller, hungrier competitors. Now you're looking at a screen full of numbers and it feels like you're trying to read the matrix. One quote is $98 a month. Another is $110. A third is $92, but something about it feels different. This is the moment of truth. This is where people make the single biggest mistake. They just pick the lowest monthly number. Please do not do that. The cheapest price is not always the best deal, and I'm going to show you how to tell the difference. First, you need to create your own comparison chart. Open a spreadsheet or just grab a piece of paper and a pen. Make columns. The first column is the insurance company's name. The next columns are for the key coverage points: bodily injury liability, property damage liability, uninsured motorist, collision, comprehensive. List them all out. Now go through each quote one by one and fill in the blanks. Don't just look at the price, look at the numbers next to the coverages. Is that $92 quote offering the state minimum of $15,000 for bodily injury liability, while the $98 quote gives you $50,000? That $6 difference is buying you an immense amount of financial protection. If you cause a serious accident, $15,000 in medical bills will be gone in the blink of an eye. You'll be on the hook for the rest. That cheap policy just became the most expensive mistake of your life. You have to compare apples to apples. Make sure every quote has the exact same liability limits that you decided you need back in part 2 of this series. If a quote is lower because it's offering you less coverage, it's not a better deal. It's just a worse policy. Next, look at your deductibles. The collision and comprehensive deductibles are the amounts you pay out of pocket before the insurance company pays a dime. That $98 quote might have a $500 deductible, while the $92 quote has a $1,000 deductible. Ask yourself a hard question. If you got into an accident tomorrow, could you comfortably write a check for $1,000? If the answer is no, then saving $6 a month is a terrible gamble. Paying a little more each month for a lower deductible is essentially prepaying your peace of mind. It's a trade-off only you can decide on, but you have to make the decision consciously, not by accident because you only looked at the monthly premium. Now scrutinize the fine print for extra add-ons. Does one policy include rental car reimbursement while the other doesn't? What about roadside assistance? Sometimes a company will throw these in for a few extra bucks, and sometimes it's the reason their quote seems slightly higher. If you already have roadside assistance through your credit card or an auto club, you don't need to pay for it twice. Get rid of it and see how that affects the premium. Make sure you are only paying for what you actually need. Once you've lined everything up, same liability limits, same deductibles, same add-ons, you will have the true apples-to-apples price for each company. You'll have your top contender, the one that offers the best real value. But you're not done yet. You're standing at the finish line, but there is one final move to make. This is the secret handshake. The pro move that separates the rookies from the masters of saving money. You've got your best quote in hand. Let's say it's from Company A, $495 a month. You've identified your second best option, Company B, who quoted you $102. You're going to pick up the phone. You're not going to click buy now. You're going to call the sales line for Company B, the more expensive one. When you get a human on the line, you're going to be polite, confident, and direct. You'll say something like this: "Hi, I'm ready to buy car insurance today. I've received a quote from your company, but I also have a competing offer from Company A. They're offering me the exact same coverage for $95 a month. I've heard good things about your company and I prefer to go with you, but your price is a little too high. My question is, can you do anything to beat or match that $95 price?" Then you do the most important thing: you stay silent. Let them talk. What you've just done is transform the dynamic. You're no longer just a random person looking for a quote. You are a confirmed buyer, a sale that is about to walk out the door and go to a direct competitor. Sales agents often have a little bit of discretionary power. They might be able to apply a manager's discount, or find one more obscure discount you didn't qualify for online. They might not be able to beat the price, but maybe they can match it. Or maybe they'll say, "I can't get to 95, but I can get you down to 97, and I'll throw in free roadside assistance." It doesn't always work, but when it does, you just saved money with a 5-minute phone call. It is the single most effective last-minute tactic you can use. And once you've negotiated the absolute rock-bottom price, whether it's with Company A or Company B, there's one last question to ask right before you give them your payment information. What is the discount if I pay for the full 6-month or 12-month policy up front? Almost every single insurance company offers a significant discount for paying in full. It can be anywhere from 5 to 15%. They do this because it guarantees they have you as a customer for the entire term, and it reduces their administrative costs of processing monthly payments. If your 6-month premium is $600, a 10% discount is $60 right back in your pocket. Yes, it requires having the cash available, but if you can swing it, it's like getting free money. It's the final optimization on a process you have now completely mastered. Now, before you hang up and celebrate, there's one last check. Price is king, but service is the queen that runs the castle. The cheapest insurance policy in the world is worthless if the company treats you like dirt and refuses to pay your claim when you need them most. Take 10 minutes to do a reputation check. Go to the California Department of Insurance website. They have a public record of consumer complaints against insurance companies. Is your chosen company on that list with a high number of complaints? That's a major red flag. Check professional rating sites like J.D. Power. They do annual rankings of auto insurance companies based on customer satisfaction with the shopping experience, pricing, and most importantly, the claims process. You don't want to find out your cheap insurance company is a nightmare to deal with after you've been in a wreck. A company with a slightly higher price but a stellar reputation for paying claims quickly and fairly is often the much better value in the long run. And so we've reached the end of our journey. Think about where you started. You were probably paying too much for a policy you didn't fully understand. Now look at what you know. You know how to assess your real needs, how to choose the right liability limits to protect your future. You know how to clean up your record and position yourself as a low-risk driver. You know which discounts to hunt for and how to ask for them. You know how to shop the market like a pro, how to compare quotes on a true apples-to-apples basis, and you know the final moves to make, that last-minute phone call and that pay-in-full question that can squeeze out every last dollar of savings. You are no longer just a price taker. You are in command. You are in control of one of the biggest expenses in your driving life. The power has shifted from the insurance companies to you. All it took was a little bit of knowledge and a strategy. Now the only thing left to do is to take that final step. Choose that policy, make that payment, and enjoy the peace of mind that comes from knowing you're not just insured, you're insured smartly. You have the best possible coverage for you, at the absolute lowest possible price you could achieve. That is a victory worth celebrating. Drive safe, save money, and know you've earned it.